Hello and welcome to AI Market News by LM.
This video's audio is automatically generated by NotebookLM, an AI-powered tool.
The reference sources used in the summary are listed in the video description.
As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech.
And remember, this video does not provide investment or trading advice. Please make investment decisions at your own discretion.
Okay, let's dive in. Today, we're navigating the really intricate currents of the global financial markets.
That's right. We'll be looking at everything from equity movements, currency shifts, and those key economic indicators.
Our mission here is to cut through the noise. We'll use the prepared resources to give us a concise, structured summary of the overall market.
Help us spot the most important signals.
Exactly.
Okay.
So we can all understand what really matters in this complex landscape right now.
Okay, let's unpack this. There's definitely a lot going on.
For sure. Kicking things off, there's a clear sense of caution, wouldn't you say?
Yeah, definitely feels that way. We've seen kind of a sour September start for stocks and bonds.
And that negativity sort of spilled over into the Asian session too.
So what's the big picture takeaway, especially when we look at the bond market? That seems pretty active.
Oh, absolutely. The bond market is seeing some intense pressure, a real squeeze, particularly at the long end of the curve.
The long end. So bonds maturing way out in the future.
Precisely. And they're super sensitive to long-term inflation and growth views. We're seeing pretty significant bond prices falling, yields climbing.
How high are we talking?
Well, the 30-year U.S. Treasury yield, for instance, it's been getting really close to that 5% level.
5%, okay.
And over in the U.K., gilt yields. Wow. Levels we haven't seen since 1998. The 30-year briefly hit 5.72%.
Since 98, that's quite a jump.
It is. And even German 10-year bonds are up, highest since March, around 2.80%.
So what's behind this? Why such a big synchronized move across major economies?
It's really a mix of things, a confluence of forces, you could say. First, governments issued massive amounts of bonds post-pandemic, to cover all that spending. So there's just a huge supply hitting the market.
Right. More supply usually means lower prices, higher yields.
Exactly.
Oh.
Second, there are growing concerns about, government fiscal efficacy, basically. How well governments are managing their money. Think about the UK. Uncertainty around their budget coming up. And third, inflation risks just haven't gone away globally. They're still looming.
So massive supply, worries about government finances, and inflation.
It all adds up. Investors are demanding higher returns, higher yields to hold government debt now. We did see strong demand for Japanese 10 years recently, and a UK bond sale, the syndication, went okay.
But the question is,
can the market keep absorbing all this incoming supply without yields pushing even higher? That's the big question.
So the market's basically saying, hey, government's borrowing isn't going to be so cheap anymore.
That's a good way to put it. And it's not just economics, is it? Geopolitics is definitely casting a shadow.
Right, that's a crucial point. What's happening there?
Well, beneath the surface, geopolitics is shaping sentiment too. China, for example, recently held a major military parade for the 80th anniversary of the end of WWII.
Okay.
And it was a notable gathering. Xi Jinping, Putin, Kim Jong-un were all there. Many see that as a show of unity, maybe even a challenge to the Western-led order.
And various news commentary has picked up on this?
Yes, including former President Trump's accusations that they're, quote, conspiring against the U.S. It adds another layer of tension.
That is a heavy backdrop. So how do these rising bond yields and these geopolitical tensions, how does that hit the stock market? What's the impact for equities?
It's a really important connection. Rising bond yields directly impact how we value stocks, especially companies focused on long-term growth, like a lot of tech firms.
How so?
Well, when bonds offer higher, safer returns, the future potential earnings of those growth stocks look less attractive today when you discount them back. It's a definite knock-on impact from bonds.
Puts pressure on tech valuations because the cost of borrowing, the cost of capital essentially goes up.
Exactly.
Okay, so this is where it gets really interesting, especially for U.S. stocks. The S&P 500, the NASDAQ, the Dow, they've all been watched closely.
For sure. The S&P had its smallest monthly gain in August in almost a year. And September, historically, it's not always the kindest month for stocks.
So what's grabbing our attention in the U.S. equity space right now? Looking at specific companies or the overall mood?
Well, it's definitely a mixed bag, particularly in tech. It tells us the market's being really selective. It's not like everything's going up together anymore.
Okay, give us some examples.
Right, so Alphabet saw its stock surge. Why? A U.S. judge decided not to ban its big search deal with Apple.
Oh, the one that brings Apple a lot of money.
Yeah, about $20 billion a year for Apple. The judge also didn't force Google to sell its Chrome browser, though they do have to share some search data. So, despite Google appealing parts of it, the market saw it as a big relief for them.
And Apple, presumably, got a boost too.
Absolutely. Apple shares rose because that Google deal stayed intact. But then you look at NVIDIA.
What happened there?
Its stock was softer. It actually dipped below its 50-day moving average. That's a technical signal that often suggests short-term momentum is weakening.
Interesting. And other big tech names.
Mixed results again. Netflix saw a small gain, but Amazon, Tesla, Meta platforms, they were all down.
So really selective, as we said. What about the AI space more broadly? Seems like there's constant movement there.
Oh, it's a real hotbed of activity. Intense competition, big talent shifts. For instance, Apple's lead AI engineer apparently left for Meta.
Really?
Yeah, and reports say 3 others from that team might be heading to OpenAI. Just shows the fierce race for talent.
And funding seems to be pouring in too.
Absolutely.
Yeah.
Anthropic just closed a massive $13 billion funding round, tripled its valuation to something like $183 billion.
Man.
And OpenAI bought a product testing startup for over $1 billion. So yeah, intense competition, lots of money moving around, rapid innovation. It creates excitement, but also volatility.
Outside of the tech giants, what about trade tensions and U.S. manufacturing? Those are still big themes, right?
Definitely critical areas. On the trade front, the U.S. revoked TSMC's waiver to ship certain equipment to its chip facilities in China.
Similar to what happened with Samsung and SK Hynix.
Exactly. It's part of the U.S. effort to limit China's access to advanced semiconductor tech for national security reasons. And of course, that impacts the global chip supply chain.
And manufacturing data.
The August ISM Manufacturing Index came in at 48.7. That's the 6th straight month of contraction, and it was below what analysts expected.
So manufacturing is still struggling, likely partly due to those tariff pressures.
It seems that way. Although one small positive sign, new orders actually rose a bit to 51.4. So maybe a little resilience there, but overall still contracting.
Okay, with all this stuff swirling around, geopolitics, tech ups and downs, trade issues, how can we get a handle on the market's overall mood? Is there a good way to gauge investor sentiment without getting caught up in the emotion?
Yeah, that's where something like the CNN Fear and Greed Index comes in really handy. It's like a barometer for market emotion.
How does it work?
It uses 7 different indicators, things like market momentum, how the S&P 500 is doing versus its 125-day average, stock price strength looking at new highs versus new lows on the NYSE,
Okay.
stock price breadth using something called the McClellan Volume Summation Index. It also looks at options traded to put-call ratio, market volatility, the VIX versus its average.
Right, the VIX, the fear gauge.
Exactly. Plus safe haven demand, comparing stock versus bond returns, and even junk bond demand, the yield spread there.
So it pulls all that together.
Right, into a single score from 0, which is maximum fear, to 100, maximum greed. It gives us a quick snapshot of how investors are feeling. It's a useful tool, reminds us not to just react emotionally, but to look at fundamentals too. Hashtag currency pairs and macroeconomic indicators in focus.
Okay, let's shift gears a bit and look at how all this is playing out in the currency markets. What's the story with the major pairs like your USD and what data is moving them?
Well, based on the prepared resources, the EUR-USD pair was actually up slightly, just under 0.1% earlier.
What's influencing that? European data?
Likely, yeah. Recent Eurozone economic data and maybe some commentary from the ECB. President Lagarde spoke earlier today, Wednesday, September 3rd. August PMI showed modest growth, composite at 51.0, services 50.5, but it was a bit mixed across different countries.
So not overwhelmingly strong, but maybe slightly supportive for the euro.
Perhaps. Eurozone producer prices for July were also pretty flat, so nothing dramatic there.
And what about the yen? We mentioned political uncertainty in Japan earlier. How's USD-JPY looking?
The yen weakened a bit against the dollar. USD-JPY was up about 0.2%. That political uncertainty we talked about, discussions around the prime minister, potential party resignations, that seems to be weighing on the yen.
Even with strong demand for their bonds recently.
It seems so. They had a very strong 10-year bond auction on Tuesday, best demand since October 2023, apparently. But the political situation seems to be the bigger driver for the currency right now, alongside the different paths the central banks are on.
Got it. Now, turning back to the U.S., we've had a whole bunch of economic indicators out this week. What's the overall picture they paint?
Yeah, busy schedule. Today, Wednesday, September 3rd, U.S. time, we got mortgage rates, the MBA, 30-year, at 6.69%. Applications down slightly.
Okay.
Durables, excluding defense for July, were down. Factory orders also down, though actually better than the really gloomy forecast.
Any labor market data?
Yes. Joel Teeth's job openings for July came in a bit under expectations at 7.38 million. Suggests maybe a slight cooling in labor demand.
So a bit of a mixed bag, maybe leaning towards a subtly cooling economy.
That seems to be the read. And we're still waiting for the Fed's beige book later this afternoon, 2 p.m. Eastern, and FOMC member Kashkari speaks around 1:30 p.m. Eastern. So more insights could come from those.
And speaking of the Fed, let's talk about the CME FedWatch tool. What are the markets thinking about the next rate decision?
Always a crucial tool to watch. It tracks the implied odds of FOMC rate moves. The next meeting is coming up September 17th, 2025.
And the chatter is about cuts, right?
There's definitely discussion about potential rate cuts. Some experts think a September cut could be on the table. But the overall message seems to be one meeting at a time.
Why to caution?
Because the economic signals are just so mixed. We've got, full employment technically, but hiring seems sluggish. Inflation is near target, but services inflation is sticky.
And that AI boom factor.
Right, the potential disinflationary impact from AI is huge, but it's not fully showing up in the data yet. So lots of cross currents for the Fed to navigate.
Plus, there's noise around the Fed leadership itself.
Yeah, reports suggest the Treasury Secretary starts interviewing potential successors to Jerome Powell on Friday. 11 contenders mentioned, and there's still that legal challenge involving Governor Lisa Cook. So a bit of institutional uncertainty there too.
Wow, okay. Definitely a lot of moving pieces. So if we step back from the day-to-day noise, what does this all really mean for the bigger economic picture? What are the underlying forces at play here?
That's the key question, isn't it? Looking structurally, U.S. GDP growth, while it's solid, it's also kind of sluggish. Probably tracking closer to 1.5% than the maybe 2.5% some had hoped for.
And what's driving that sluggishness?
A few things. Those tariffs we discussed are likely a factor, adding friction and uncertainty, slowing things down a bit.
Okay.
Also, labor force supply seems constrained. There are reports, for instance, about undocumented workers maybe not showing up for work in sectors like construction, agriculture. That can make the unemployment rate look low, even if hiring feels slow for businesses.
Creates a weird disconnect.
Exactly. And then there's the AI data center boom we mentioned.
Right, the game changer. Is that having a real economic effect yet?
It's seen as a massive disruptive force, but ultimately constructive. It's expected to boost productivity growth and be disinflationary, help keep prices down. We aren't seeing its full impact in the numbers yet, but the potential is huge.
And what about the inflation outlook overall? Still sticky?
Service sector inflation definitely remains sticky. That's the persistent challenge. But interestingly, goods inflation globally has actually been disinflationary for about 2 years now.
Why is that?
Largely due to overcapacity in Chinese manufacturing. So that suggests the impact from tariffs might be more of a one-off bump and could moderate over time. Especially if the AI boom adds disinflationary pressure and sluggish growth keeps demand for goods in check.
So the inflation picture is still pretty complicated.
Very much so. It's not a simple story.
Given all these complex, sometimes conflicting signals, how important is it for us to understand market psychology?
Oh, it's crucial. That fear and greed index we talked about. It helps gauge the mood. It's a good reminder, especially when things get choppy, not to make purely emotional decisions.
Right, don't just react out of fear or greed.
Exactly. For us, as informed watchers of the market, it's vital to combine those sentiment ratings with solid fundamental analysis. Make rational choices, not just react to the noise.
Okay, as we start to wrap this up, let's look ahead. What should we be keeping a close eye on, referencing, say, the investing.com economic calendar? What are the key events coming up?
Right, looking forward, there are definitely a few things on the radar. The big one this week is Friday's critical payrolls data.
Always a market mover.
Absolutely. It could significantly shift expectations around Fed rate cuts.
Yeah.
Then, longer term, obviously, that FOMC meeting on September 17th remains the main event for central bank watchers.
What else internationally?
Well, back in Japan, keep an eye on the 30-year JGB auction on Thursday, September 4th, U.S. time. That'll be another test for their bond market, especially with the political backdrop.
And any other global points?
Yeah, we're also watching things like India's potential trade deal discussions with the U.S., and there's a rate decision coming from the Polish central bank, too. So always something happening globally.
Okay, so it's clear that global financial markets are navigating some really complex waters right now. Bond yields surging, tech performance all over the place, geopolitical factors. Understanding how these pieces fit together is just crucial for staying informed.
Absolutely. And maybe the key takeaway is this. In a time with so many crosscurrents, trying to perfectly predict the future is probably less useful than being a good risk manager. Meaning, focus on the immediate data, stay adaptable, adjust strategies meeting by meeting, Fed meeting by Fed meeting, data point by data point. Understand the landscape is constantly shifting.
So it's more about being prepared and adaptive, rather than trying to have all the answers up front.
Precisely. It's about continuous learning and adjustment in these complex times.
Great insights. Thanks for breaking that all down for us.
Happy to do it.
Thanks for watching. Don't forget to like and subscribe.